The last time the stock market looked like it does right now, most people thought the hard part was over. Markets were strong, stocks felt unstoppable, and investors started believing that all you had to do was buy anything out there and wait. That period didn't end the way most people expected. But here's what almost nobody talks about. During that time, everyday investors, not hedge funds, quietly built enormous wealth. And what everyday investors was that? The investors who were based on fundamentals and understood markets. So as we kick off 2026, the question becomes, how did those people do it and how can we replicate that? I'm going to get straight to the point. They did it by staying disciplined when others weren't. Munger and Buffett always say, our goal isn't to be smarter than everybody. Our goal is to be more patient and more disciplined than everybody. When everybody else is acting stupid, if you remain calm and if you do the right things, you will win in the long run. So in this video, I'm going to walk you through exactly what happened last time, who really benefited, and more importantly, what you can do now to prepare yourself for the next part of the market cycle. Because as of right now, we're in a market that feels phenomenal. Every single day is up. Indexes hitting all-time highs. Many stocks have had massive runs these past 3 years, and there's a sense that as long as you stay invested, everything will work out. The buy the dip mentality. And just to be clear, this video is never about predicting an immediate crash or calling the top. I will never do that. Markets can stay strong far longer than people would ever expect, but it's about recognizing where we are in the cycle. We have been here before many times across many different assets. This is not new. In the late 90s, investors were convinced that a new era had arrived. And guess what? It did arrive. The internet was changing the world, just like AI is likely to change the world today. And because the story was true, people stopped paying attention to price. That's when investing quietly turned into speculation. Not overnight, but slowly over time. So yes, markets created a ton of paper millionaires back then. But when reality showed up, most of those gains disappeared just as quickly as they arrived. What separated the people who built lasting wealth from the people who didn't was having a disciplined process. And that's what we focus on at Everything Money, not allowing our emotions to get the best of us. So by the end of this video, I'm going to show you the exact process investors followed to make millions and how you can do the same. But here's the deal, guys. It doesn't happen overnight, and it takes discipline. So what happened in 2000? Well, the NASDAQ ended up falling about 80% from its highs. In fact, it didn't reach a new high until 2014. That is 14 years of zero returns on price. So you're probably asking me now, Paul, how did anyone possibly benefit from that? Well, the people who benefited were the steady, disciplined investors who stuck to their process and understood what they were buying despite all the noise. Very few investors actually have the stomach to handle a drop of 50 or 60%. But guess what? Everyone thinks they can because they're thinking from today's mindset and today's news cycle, not this news cycle that would occur if stocks fell 50 or 60%, because news follows the stock price. And even few people are able to consistently keep buying week in and week out as stocks go down. But, and this is a big but, and this is a guarantee in life, the ones who are capable of dollar cost averaging into these indexes time and time again, as long as you believe that the US economy will be bigger and better as time goes on, those are the ones who did very well. If you bought QQQ, the NASDAQ 100, at the peak in March of 2000, it ended up falling 80+%. But if you dollar cost average starting on that very peak day of March 10th, 2000 till today, you made over 14.5% annualized returns. Now, here's the important part you need to remember. It sounds simple. It sounds very straightforward, but very few actually executed this strategy. I have a story from back then, from when I was young and newer to the investing game. The market was booming. I was caught into it, and I was looking for any way I could find the next big hot stock. And a friend of mine, well, it's actually my sister's boyfriend's parents, came to visit us and meet them. And they said, Paul, what do you do? I said, I'm interested in stocks, blah, blah, blah. The father looked at me and said, Paul, I got a great stock for you. Global Crossing. They're putting fiber across the entire world. I bought it. I loved it. And it started to go up and I felt brilliant. And Forbes magazine had the CEO on the cover. He was the fastest billionaire ever in like 11 months. Guys, where's that stock today? Just a few years later, it was zero. And I wrote it all the way down. So Why is this so important for us at the beginning of 2026? Well, let's start with this. The Shiller PE ratio, that's the 10-year PE ratio. It takes the last 10 years of earnings on the S&P, brings it to today in inflation-adjusted dollars, and says, what's the PE today? Takes out the highs and lows. The highest it's ever been was late 1999 at 44 times earnings. Before then, the highest it had been at a peak was like 26 or 27. The second highest it's ever been, going back 100 and some years, right now, at just over 40. Guys, why does that matter? Well, it's just basically saying, what are you paying for the last 10-year inflation-adjusted earnings on the S&P? If that's not enough for you to be concerned, I question about understanding what PE is. Now, I'm not talking about a one-year PE, because those can be meddled with a lot of different garbage in there. Like during 2009, all the banks' earnings were down, so the earnings fell, blah, blah, blah. But this allows instead of earnings going like this, what you want it to do, it does this. That 10-year PE flattens it all out. And at 40 times earnings, that's a lot, especially considering the historical average is around 17. What about the Warren Buffett indicator? Warren Buffett's favorite metric for deciding whether or not the market's overpriced at any given moment. It takes the stock market and compares it to US GDP. And it makes sense. As US GDP gets bigger and bigger, so should the stock market. Before the past few years, the high in 1999 was 150%. We are now at over 230%. Guys, even if you don't focus on these metrics, it's enough indication to at least start to prepare mentally and emotionally just in case the next 10 years don't look like the last 10. That's all I'm trying to do here. I'm not trying to tell you, here's how you make a killing in the next 10 years. Well, I am trying to do that, but in a different way. Not by picking the perfect investment that will skyrocket today. It's about doing the right things today and having the right mentality so you go, this is what we expected because stocks were very overpriced. This is why I teach on YouTube, guys. I saw all these people on YouTube saying all this garbage. I saw people in school saying all this garbage. I remember being taught modern monetary theory in college. I wish I could go back in time and wring my professor's neck saying, this is stupid. And he believed it. These are the things about why I teach. Because I sit there and say there's another way of looking at the world, and it's usually the opposite of what people are doing. So you're probably asking yourself the same question I would. What should I focus on in case the market crashes in 2026? Trust me, I get it. You want to make sure you're prepared. But guys, people think preparation means picking the exact right stock to go up. That's not the case. Lesson 1, stay invested. Make educated choices. I want to let you in on a little secret. No matter what you hear, no matter what is going on, the stock market is not going to zero ever. And if it does go to zero, your money would have done zero good for you anyhow, so you might as well put it in the market. Because if the stock market goes to zero, the economy went to zero, and whoever has the most guns and land will probably win. So please stop sitting there saying, what if the stock market goes to zero? Now, with that said, could you worry about an individual company going to zero? Absolutely. But what companies are those? That's the question. Guys, back in 2006, I met with my buddy, and I always tell this story on the channel because it's so powerful. Met with my buddy and his new wife. I said, Paul, we want to save for retirement. I looked at their plan. I'm like, guys, you guys are all set. I go, but let me ask you a question. If stocks fell 50% tomorrow, what would you do? And the wife looked at her husband and looked at me kind of confused and said, we'd buy more, right? I said, perfect. I said, you get it. And I really left the house going, they get it. That was 2006. Fast forward to 2.5 years later. I get a frantic email from the wife. Paul, what's going on here? I'm worried about stocks going to zero. And I said, well, if you remember our conversation, we said we'd buy more. So you're actually buying more? Yeah, that's what we discussed. Paul, I can't do it. I'm worried about my stocks going to zero. Like, okay. And they went completely to treasury bills. Guess what happened? They looked smart for a short period of time. And then it took them a while to get back in when they felt safer. And by that point, stocks were higher than when they originally sold. The best place to start for most investors is dollar cost averaging into low cost ETFs. You do this by investing the same amount every month, no matter how the market is behaving. That's the important part. You need to remove the emotional guesswork. That's what builds wealth steadily over time. Because if I went back to that couple today and said, look at the market right here. Do you wish you'd bought it this low? They'd have said, yes, of course I do. But Paul, things thought the world was falling apart. Yeah, I know the world felt like it was falling apart. We thought the world was going to zero because the financial system was going to shut down. It didn't. It rarely does. In fact, I don't remember the last time the financial markets completely shut down. It is so important that you don't get caught chasing the hype or the bad stories. if they had dollar cost average into low cost ETFs for that 1 year period, they would have several $100,000 more than they have today. Now, if you decide to shift from ETFs to the next big tech stock without knowing how to invest in individual stocks, you're going to end up getting burned the same way I did with Global Crossing. Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're going to get our stock analyzer, our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days. You'll see. This isn't gambling. It's common sense. So, lesson number 2. I want you to buy great businesses. But, and here's the big but, only at great prices. When I do look at individual stocks, I don't look at the price. I don't look at the narrative around it. I figure out what is the stock worth to me based on the business's value divided by the number of shares outstanding. If the price is higher than what I value the business at, I'm not a buyer. If the price is lower, I'm a buyer. I dig into certain key aspects that tell me how well the business is doing. For example, how much is the cash flow generating? Is that cash flow going up? Are they buying back shares? Are they paying a dividend? What are they doing with their money? What does history look like for them in terms of revenue growth? Also, I got to look at their balance sheet. Is their debt manageable? I need to make sure that the company is not at risk of bankruptcy, because guess what? If it goes to zero, it would take an infinite return to get my money back, and that ain't happening. But in addition to their debt, I need to worry about those cash flows and revenues and profits growing. Because if I pay a reasonable price today and the company is able to 10x the business over the next 20 years, I will probably 10x my money. That's the way I look at all these stocks that I buy. I'm buying a piece of a business. Whether it's a growing business or declining business, it still has value. But of course, I'd rather buy a growing business and just let time take care of itself. And one of the most important metrics I use to figure out if it's a great business or not is return on invested capital, ROIC. This shows me how well a company is able to generate profit off the money that they invest in their business. So if they generate high profit off of money in the business, that's way better than a company that generates very little profit off its money invested in the business. Now, there's one last piece I haven't mentioned yet, whether the price today makes it an attractive investment or not. And I'm going to show you exactly how I do that in just a few minutes. If it's not at the price I want, I wait. So guys, let me tell you a little story that's always stuck with me. I've told it in this channel before, but it's really important because I see so many people buying into the hype in the story right now, thinking that it'll work forever because it already has. Back in college, like 2002 or so, I went to a barbecue that my dad's doctor friend was hosting. And he said, "Hey, Paul, what are you in college for?" I said, finance, economics. He said, "Oh," he's like, "You like the stock market?" I'm like, "Love it." He's like, "Oh, I got killed." I'm like, "Really?" He goes, "Yeah." He's like, "I held these .com stocks. And at one point I had over $5 million in these stocks." I go, "Well, what is it now?" He goes, 50,000 maybe. And I was just like, oh my God. So first off, I respected him so much for being honest about it. And he was so cavalier. Like he didn't care. He's just like, "Listen, I was up 10x and then I lost 99%. Now, that's a great story because he bought into the hype. And for a while there, he looked right. He didn't invest $5 million. He invested like 500 or 600,000 and it went up 10x. And he just kept riding it out. I give him credit for riding it out. But that is exactly what is probably going on today. Now, I'm not saying that all stocks are going to go down that much, but there's going to be stocks that lose massive amounts of value. If you look at our videos from 2021, 2022, when it came to cannabis and electric vehicles, we said these companies are garbage, and a lot of those went down 100%. But before we get into the third lesson here, I want to show you what I look at when I look at analyzing a stock and how I wait if it's not selling at the right price. Meta Platforms is the company behind Facebook, Instagram, WhatsApp, and Facebook Messenger. At its core, Meta makes money by selling digital advertising, using its massive global user base and data to help businesses target customers more effectively. Guys, I'm going to show you right now with Meta what I'm talking about. So let's look at Meta here. Meta is a great business. Market cap, 1.7 trillion, free cash flow of 45 billion. enterprise value of 1.77. You probably never heard this before, but the difference here is essentially the debt. So guys, they have $70 billion in debt, and they generated $45 billion last year in cash. Imagine if all the debt you owed in the world, you could pay off with a year and a half of your cash, of your disposable income. Not your income, your disposable income, after all your expenses and everything. That would be incredible. That's Meta right here. Okay, let's look at the 8 pillars. Great company. Great returns on capital and growing. Buying back shares, hopefully that's good. Cash flow's up in the last 5 years. Net income's up. Revenue's up. Low debt, like I said. It's just these 2 metrics. Price to free cash flow and PE ratio over the last 5 years. Now just remember, seeing a red X doesn't mean they're overvalued. If I were to tell you right now that Meta was going to double its profit for the next 20 years, I would pay 3 times this PE and price to free cash flow to get that. If they can grow their profit and their free cash flow fast, they deserve a premium. That's what Buffett and Munger say. When you buy a top quality business, it might feel like you're overpaying based on these numbers, but you're actually not. Let's see what analysts think about this company for the future. Actually, not much growth in the next 3 years. $31 a share going to $39 a share. Not a huge amount of growth. Kind of surprised by that. Revenue though, I'm surprised by this. How is revenue growing 17, 15, 15, and 12%, and profits only growing 11, 14, 1%, and 9%? That doesn't make sense to me. I think they're wrong on that one. This is what I do. I go to Stock Analyzer tool. I sit here and I input my assumptions for the future. And I can pick anywhere between 1 and 20 years. And I go revenue growth, profit margin, free cash flow margin. What's my PE and price to free cash flow 10 years from now? And then what is my desired return? This doesn't include the balance sheet, but it tells me, Paul, if this company is able to grow like this for the next 10 years, it should be worth roughly this amount, and this is the return you get on it. So let's go pull up the last time I did Meta. I did a 10-year analysis. I did 6, 9, and 12% revenue growth. Might be high based on what analysts are, it might be low based on what analysts are saying, but I'm fine with this. Profit margin and free cash flow margin. I put 30, 34, and 38. I put high numbers here because they have a high margin. So that should drive up their profit considerably. If you want to be more conservative, go more conservative. In fact, I'm going to do that. I'm going to go with 28, 32, and 36. Now, what PE and price of free cash flow would I assign to this company 10 years from now? Well, its ROICs are getting better, so it means it's a good business. It's all over the place, so I think this company deserves a premium to the 15 or 16 average in the market. How much of a premium? I put 20, 23, and 26. You might disagree with that. You might say higher, you might say lower. Completely up to you. That's why when you have access to this, it allows you to make better decisions. And finally, I'm only trying to figure out my intrinsic value, my 9% market return. This has no margin of safety in it. It's just saying, Paul, based on your assumptions above, this is what this company should be worth. I hit the analyze button. And guys, I have a low price of $475, high price of almost $1,200, middle price of $750. This is what makes me go, okay, I lowered my assumptions a couple times and we're still above the value. I need to take a deeper look at this. But guess what? Back in 2022, nobody wanted it. Why? Because the stock was down. It got down to $88 a share. We were buying it and people said, Paul, you're missing out. This is a terrible company. We need to fire Zuckerberg. And I was like, how is it a terrible company when revenue and profit keep increasing? Everybody's worried about the metaverse and how they're spending $10 billion a year. And I'm like, yeah, but if it fails, they stop doing it and they all of a sudden make $10 billion a year more and the other cash flows are still growing. So that's a big key in how I buy companies. I want to sit there and run Stock Analyzer to make sure it's even in the ballpark for me. Because let's say, for example, this price came in at 100, some extreme low. Why would I waste my time? The stock's currently at 650 or so. I'm not going to waste my time looking at a company that's selling for 650 when I think a value is 100. And the other way around, let's say this value was 2,000. You better believe I'm going to spend a lot of time when the stock is selling for 650 and Stock Analyzer tells me it's worth 2,000. These are the important aspects in how you use Stock Analyzer tool to make you a better investor and to save you time. Now, finally, lesson number 3. I follow my 5 tenets of principle-driven investing to a T. Guys, I have to say it emotionally like that because I cannot tell you that when I sat there and thought to myself, what are the ways in which I think about investing? These just came to me, well, over time. But these are the 5 principles that are posted in my office, in the studio, everywhere. They are the guardrails that keep me from making costly mistakes and hurting my long-term returns. It is so important to repeat the basics. It's so important to remember these core principles that should be driving factors behind every investing decision you make, no matter what it's in. This is exactly how you avoid allowing yourself to get caught up in the headlines like so many investors like myself did in 2000, and I think like so many people are doing today. So here are our 5 tenets. 1, we are investors, not speculators. 2, every investment is the present value of all the future money it is going to generate. 3, if we don't understand it, we don't invest in it. 4, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And 5th, and probably most important one, and very relevant to today, a great story becomes a bad investment if you pay the wrong price. Now, you don't need to write those down. I created a simple, free cheat sheet for you. Click the link below, and we will send you the PDF of all 5 of these tenets, as well as explanations of them, right to your email so you can print it out, keep it ready for you, keep it on your phone, always readily available. And I recommend you read it daily. So listen, guys, there will be cycles in the stock market that will never, ever change. There will be bubbles that will never, ever change. And the other thing that'll never change is they will burst. But the S&P has averaged around 10% a year since its inception, despite the Great Depression, 2 world wars, dot-com bubble, presidential assassinations, everything you can imagine. So guys, just recently, I created a video explaining the exact 3 ETFs that I would choose today if I just start over with nothing. So if you want to see how it would still allow me to retire a millionaire, check the video out right now. Thank you for your time.